Good evening, everyone, and welcome to our focus session on mastering price action in forex trading. I'm thrilled to see so many inspiring and seasoned traders joining us today. We are here to navigate the interstate movements of the forex market together, uncovering the secrets behind successful trades and risk management strategies based on the price action techniques. And this is the second session of our uh, three-session course on price action. Our journey today will take us through the dynamic world of breakouts, reversals, and the crucial indicators that signal these movements. So whether you're looking to refine your technical analysis skills or build a solid foundation in price action, this webinar is designed to elevate your trading expertise. Let's just dive in and demystify the charts armed with the knowledge that will empower us to make informed strategic decisions in forex markets based on price action techniques. So please let me know if you can hear me and you can see my presentation clearly. So if everything is fine from your end, that would be a comfort to continue. So I will give you guys a moment. Please send me confirmation through a chat box by sending one yes or anything that you're more comfortable with, and then we will continue. Thank you. Perfect, thank you. Thank you so much for your confirmation. So very well. So let's turn those insights into action and those actions into profitability. Prepare your notes. Let's embark on this educational voyage together. Very well. As you know, this webinar is brought to you by Errante, which is an online broker committed to providing top-tier services and building lasting and trusting relationship with clients and partners. As we proceed with today's webinar, I want to remind everyone again that the insights and strategies discussed are for educational purposes only. So none of the contents provided should be taken as investment advice or as trading signals. We're here to learn and explore the financial markets together. So please make sure to do your own research before any trading or investment decision, because as you know better, the CFDs products are really risky. So it mostly depends on your risk tolerance, your capital, your financial knowledge, and finally, you are the one should make the final decision about trading in forex. Okay, let's take a look at our outcomes for today. As you see, we will go through the price action techniques, some advanced techniques, let's say in 4 different sections, with discussing the different shades between reversals and correction. And then we will see how we can incorporate the moving averages and also the RSI as a very, very simple tools, but very, very effective to grasp a better understanding of the market sentiment and market momentum. And based on that, we are going to develop a strategy to trade the market. It's easy. Yes, it sounds really easy, but uh, it's supposed to be really profitable and effective. So please stay with me until the end of this webinar. And please know that we have interactive Q&A, so you can participate in dynamic Q&A during this session. If you have any question, please write it down to me, and I would be more than happy to answer that if I know the answer. By the way, at the end of the webinar, we will, let's say, review all the questions, and if you have any inquiries or something related to our topic today or the titles that we are gonna discuss today, or from our previous webinars, please don't hesitate to share your idea, your thoughts with me. Very well. So far, so good. Perfect. So let's start from this point, distinguishing between reversals and corrections. Uh, it becomes a cornerstone of successful trading. Let's break down the most common rules used by professional analysts and traders to navigate these challenges. First, we must grasp the core of our analysis. That's the start with volume. A significant increase in trading volume can often precede a reversal as it indicates a strong shift in market conviction. And in contrast, corrections typically occur with less dramatic changes in volume, suggesting a temporary pause rather than a change in trend. So this is the first clue that we can extract from the market to gain a better understanding on what's going on, if it's a correction or it's going to be a real major reversal, let's say. Then candlestick patterns also provide invaluable insights. Patterns such as engulfing, harami, and especially the indecisive doji can signal potential reversals. Their appearance at the ends of a trend should prompt us to pay closer attention to other indicators for confirmation. And, for example, when you see a reversal candlestick pattern at the end of let's say, a rally to the upside or downside, if you shift to lower time frames, you will be able maybe to distinguish a market reversal at the lower time frame. So for now, we consider candlestick patterns as a sign of market correction. And in, let's say, the broader view on the market, we consider the price patterns as a signal or trigger of market reversals. But as you know, we discussed candlestick patterns and also we discussed the chart patterns our previous webinars. So let's move on to the rule of moving averages that cannot be overstated. A crossover of a short-term moving average above a long-term average may indicate the beginning of an uptrend and vice versa for a downtrend. It signals a potential reversal for the market direction. And I assume all of us know that about trading with moving averages, but you will see how we can incorporate this very, very precious tool, simple tool, and effective tool with other oscillators and indicators to develop an effective strategy, trading strategy. And then we have support and resistance levels, trend lines, channels, and price levels, psychological levels, and etc. All of these offer another layer of analysis to us. A clear breakout from these patterns often signals a reversal, breaking the previous price action structure and setting a new direction. Especially, it can be very significant sign of market reversal when we can have all of these elements all together. The volume analysis at the reversal increasing candlestick patterns usually show a very confident market sentiment at the point of breakout, and moving averages usually come in favor of a new trend at reversal point by showing a crossover sign or triggering the let's say the negative slope or positive slope in favor of the new direction of the market, and then a breakthrough at very important key levels. So if you can find all of these signs together, you can get a very strong trigger to enter the market in favor of new trends. The one more tool that, let's say, we discussed earlier in our previous webinars is Fibonacci retracement tool. That's right now you know how you can use Fibonacci tool. First, to, let's say, point out the retracement levels and also the extension levels or the price projections for further or extended move beyond the previous leg in the opposite direction of the market. So Fibonacci retracement tool is a favorite among traders for identifying potential endpoints and of corrections, of course, within a larger trend. And also, corrections often terminate around the key Fibonacci levels. So it's very important to consider these levels like 38.2%, 50%, or 61.8%. And next is that incorporating economic indicators and gauging market sentiment are also critical in trading price action. A sudden shift following economic news or changes in market sentiment can often precede a reversal, making it essential to stay informed and adaptable with the market. And understanding and applying these rules will enhance your ability to distinguish between mere corrections and significant reversals, which is our aim, our goal today. A skill that lies at the, let's say, heart of successful trading strategy. Let's continue our discussion with uh, scrutinize the moving averages. Moving averages are a staple in the technical analyst toolbox, providing clear signal through their simplicity and effectiveness. Today, we're focusing on weighted moving averages, or WMAs, that most of you might know, which is my favorite moving average to use, particularly the 34, 100, and 200 periods, to distinguish between market reversals and short-lived corrections. WMAs are unique in that they place more emphasis on recent prices, making them particularly sensitive to changes in market sentiment and price movements. And this characteristic is key in spotting potential reversals early. Here is, let's say, the specific rules when it comes to use moving averages. First of all, alignment. A fundamental signal of the potential market reversal is when the shorter term, let's say 34, for example, WMA crosses over the medium term 100 WMA or the long term 200 MA. A cross above signals a bullish reversal, while a cross below indicates a bearish reversal, and I assume you all know it. Okay, so let's jump to the next rule, which is a price position relative to WMAs. The position of the market price in relation to these WMAs can further confirm the direction of the trend. If the price moves decisively and stays above the 34 or 100 or 200 WMA suggests a solidifying trend in terms of short-term, medium-term, or long-term, let's say, correction and reversal. So you can interpret the market sentiment based on the length of each short-term, medium-term, and long-term moving averages that you're using. And the next one is the slope direction, which is really important, which is the very, let's say, it's kind of the hidden weapon that we have against the market sentiment, and we can spot the shift in market sentiment using the slope and the direction of the slope or the of moving averages. The direction or slope of these WMAs provides insight into the market's momentum. Offer the slopes across the 34, 100, and 200 WMAs indicated a strengthening bullish trend, whereas downward slopes suggest bearish momentum. For practical application, closely monitor these indicators. Across of the 34 WMA over the longer term averages, paired with consistent slope direction and price positioning can confirm a reversal, differentiating it from a mere correction. Don't worry, guys, we have a practical example here. Let's look at some case study here. Yes, where these indicators were applied. Okay, excuse me, guys, for a moment. Okay, Mr. Mohammed stated that he can't see the presentation properly. Please, if you have similar issue, write it down through the chat box for me to fix the issue and maybe share it with the technical support that we have. Or please give me a second to fix the problem. If okay, Mr. Mohammed, I would say the rest of the participants have no problem with the presentation. I appreciate if you check at your end from your side. I guess the technical issue might be from your side. So maybe to resolve it, you can just log out and enter again. Very well. Okay, okay, let's get back to our slides. So, thank you for your patience, guys. Thank you. Okay, let's see. Now, let's analyze the chart in the context of the previous slides content about the moving averages. As you see here, for example, we have the price at the far distance from the 34 WMA. The slope of all of these moving averages are positive, and also it's accelerating to the upside, which mirroring the previous this long body bullish candlestick there. So in that case, we all can understand that the gold on the 4-hour chart right now is showing a very strong bullish momentum in the market. As also we can see the price is above all of the moving averages, and also the shorter moving averages above the longer moving averages. This is all signs to understand the current market sentiment. But the problem here, guys, is that we need further information for sure to evaluate what's gonna happen to this chart, to this market, golden 4-hour charts. Okay, because okay, we can understand the current situation, the current condition of the price near to the significant top here, and also we see the market is too far from the moving averages. So of course we need a way to somehow predict the future, because that's the value. For that case, we are refining in on one of the most versatile tools in a trader's arsenal, the relative strength index, or RSI. And this momentum oscillator not only identifies overbought or oversold conditions, but as you all know, but when used astutely can confirm trend reversals with remarkable accuracy. So the key to leveraging RSI for reversal confirmation lies in understanding its, let's say, optimal applications. It's very important. And the key to leveraging RSI for reversal confirmation. Okay, so we need to take a look at all of these features or the ways that we can somehow generate signal through RSI. First, the divergence stands out as a critical signal. A divergence occurs when the price movement and the RSI trajectory do not align, indicating a potential reversal. For instance, if the price hits a new high while the RSI fails to do the same, the underlying momentum may be waning, suggesting a reversal imminent. The next one is failure swing. Failure swings provide a clear, actionable signal. In a scenario where the RSI crosses back above 30 after being oversold, it suggests a bullish reversal. Conversely, an RSI falling back below 70 indicates a bearish reversal. These signals are particularly robust, offering traders a high confidence entry or exit point. And then this is an other way that you can incorporate RSI in your trading uh, is the trend line breaks on the RSI chart or another powerful indicator. Much like price charts, trend lines on the RSI can indicate an impending reversal when actually it is breached. So it's important to tailor your use of RSI to the market's conditions. In volatile markets, adjusting the overbought and oversold threshold can enhance the RSI effectiveness. Moreover, while divergence signals are more reliable in ranging markets, failure swings and trendline breaks can be particularly indicative in trending conditions. In other words, to maximize the RSI's potential, it should never be used in isolation. Combining RSI signals with other indicators and analysis tools can significantly improve the accuracy of your reversal predictions. Building on our exploration of RSI and WMAs, let's delve into how these tools together can significantly enhance our market analysis, particularly in distinguishing between corrections and reversals, which is our main topic today. In periods of correction, the market exhibits a relatively mild fluctuations. The RSI often stays within a 40 to 60 range, okay, reflecting a balanced, though indecisive market momentum. Concurrently, prices tend to hover around the 34 WMA and use the 100 or 200 WMA as a trampoline, let's say, bouncing but not breaking through, suggesting the underlying trend remains intact despite short-term corrections. Conversely, in the face of a true reversal, the RSI decisively exits its comfort zone soaring above 70 to signal overbought condition, or dipping below 30 to indicate oversold conditions. This is often mirrored by the 34 WMA crossing over the longer term 100 or 200 WMA, with the price action confirming this shift by breaking through these averages. Such alignment points to a substantial change in market sentiment, which can also point to a new trend in the market. So to practically apply these insights, look for confluence between RSI signals and WMA patterns. For instance, an RSI divergence that coincides with the WMA crossover offers a compelling case for a pending reversal. Similarly, the slope of the WMA can serve as a visual confirmation of the trend direction suggested by the RSI, providing a more solid foundation for our trading decision. Understanding and interpreting these indicators in tandem allows traders to navigate the forex market with greater confidence and understand the market sentiment, and also the all players, or let's say the powerful hands behind these market movements. So by recognizing the nuanced signals presented by the RSI and WMAs, you can more accurately gauge market sentiment, distinguishing fleeting corrections from significant reversals, and thereby refine your trading strategies for better outcome. And you will see how here in this slide. Let's explore some real-world examples where traders successfully applied these methods, demonstrating the power of combining RSI and WMAs to interpret market sentiment and capitalize on trading opportunities. Okay, here we have a compelling illustration of how RSI and WMA work in concert to provide us with vital trading signals. Notice how the 34 WMA depicted by the blue line here serves as a close follower of the price action, offering immediate insight into current trends. The 100 WMA in red and the 200 WMA in green offer deeper layers of trend analysis, reflecting medium and long-term market sentiment. Now, as we progress through the chart, observe the recent sharp upward movement in price, which is mirrored by a corresponding ascent in the 34 WMA. This movement is indicative of a strong bullish sentiment driving the market. What's particularly noteworthy in the alignments of the WMAs, the 34 WMA has crossed above both the 100 and 200 WMAs, which are also trending upwards, suggesting a significant bullish reversal rather than a mere correction. Now, let's add more value to our analysis and bring the RSI into the chart. It's currently hovering above 70, as you see, indicating an overbought market condition. However, rather than immediately signaling a reversal in this context, it confirms the strong upward momentum we're witnessing. The key will be to monitor the RSI closely for any signs of divergence or a failure swing that might suggest the market is losing steam. In practical terms, a trader would look at this chart and see a confluence of bullish signals. The RSI is high, which aligns with the strong upward move in price, and the WMA are in perfect order for a continuation of the uptrend. The market sentiment is clearly favoring the bulls, and unless we see a significant RSI divergence or shift in WMA alignment, this sentiment is likely to carry forward. But remember, As traders, we're looking for confirmation across our indicators to make robust decisions. So we are looking for an entry point to this bullish market. Here, both the RSI and WMA are telling us that the market is experiencing a strong bullish phase. That's okay. Yes, however, keep in mind that no indicator is foolproof. Always be prepared to sudden market shifts and use a stop loss orders to manage risk effectively. And this is why all traders use a stop loss. In this chart, the candlestick formation also has a lot of information for us to bring on the table. The candlestick formation complements our analysis with a story of bullish fervor again. A length and succession of the bullish candle, particularly the long whites, the long, blue one, signifies strong buying pressure. When we consider the price's significant distance from the WMA, it reinforces the narrative of a robust bullish trend again. However, this enthusiasm brings with it a cautionary note. Let's get through the cautionary note and see what it is. The RSI persistently above the 70 threshold warns us of potential market exhaustion, such as elevated level often precedes a pullback as traders take profit and the initial surge loses momentum. Given this context, let's contemplate the most probable scenario here. The market's strong bullish sentiment, evidenced by the candlesticks and their distance from the WMAs, suggests that the underlying trend is a strong support. The RSI's overbought signal does not, in isolation, forecast a reversal of the overall bullish trend. Instead, it hints at the likelihood of a correction, a brief taken by the market after a sprint. If a correction ensues, we would anticipate it to be proportional to the velocity of the preceding climb. And here, the 34 WMA could serve as the first level of support, followed by the 100 WMA, which aligns with the previous resistance, now turned support. In such a dynamic market, the retracement could extend to the 38.2%, 50%, or even 61.8% Fibonacci levels calculated from the most recent swing low to the swing high from this point to this point. For example, if we want to imagine the correction here in the market. So should the price approach these WMAs and the RSI retreats from its overbought territory without breaching below 50, the bullish sentiment may well remain intact, indicating that this is a mere pause in the uptrend. However, as we always need a plan B, a break below these WMAs accompanied by an RSI falling sharply towards oversold conditions could signal a more sustainable reversal, putting the prevailing bullish trend on the test. Clear? Very good. Very good. So moving forward for our previous discussion, let's now focus on the pivotal role of support and resistance levels in trading and how the RSI can serve as a valuable tool in these scenarios. First of all, let's start with definitions. Support and resistance levels are like the floors and ceilings of market psychology, representing key thresholds where price movements can stall or reverse. Identifying these levels is crucial as they can dictate entry and exit points and help forecast price movements. To pinpoint these levels, we'll start by examining the chart for historical price points where reversals have consistently occurred, like what we see usually during the uptrend a strong uptrend or a strong market downtrend. These are our first clues. Additionally, round numbers frequently act as psychological barriers. This is just a remind because I assume all of you have a solid, let's say, foundation on support and resistance levels. By the way, as we need to incorporate these levels to our analysis for grasping the market momentum. So I will just walk through the features and most important rules of major levels, as key levels, as a support or resistance. So additionally, I was saying round numbers frequently act as psychological barriers, creating the natural support and resistance zones due to common human biases in price perception. Now, let's integrate the RSI. When the price approaches support and the RSI is below 30, we're in oversold territory. You agree? Yes? Okay. It is suggesting the price may bounce up. Conversely, when we are near resistance and the RSI is above 70, indicating overbought conditions, the price might be due for pullback. But here is a pro tip. Watch for the RSI breaking through its own trend lines. This can be an early signal of a price breakout through support or resistance levels, giving you a head start to adjust your trades. In terms of trading strategies, consider buying near support when the RSI moves back above 30, signaling a potential upward reversal. On the flip side, consider selling near resistance when the RSI dips below 70, and this could somehow foreshadow a downward reversal. And when it comes to breakouts, look for the RSI to sustain level above 70 or below 30 after the price has crossed the support or resistance level, confirming the strength of the move. Now, let's look at some practical examples here. The charts we will examine showcase how these strategies play out in real market conditions, providing a visual guide to the interplay between RSI reading and support or resistance levels. By applying these techniques, you will be equipped to make more informed decisions, capitalizing on the market's response to these critical price levels. Yeah, here you see in this enhanced chart, we have added crucial layers to our analysis by marking out key support and resistance levels. And these levels, alongside the RSI and WMAs, provide a more robust framework for predictive analysis. Taking a closer look at the chart before at this slide, we can see that the significant resistance zone around 2065.25, which had previously acted as a ceiling for price, has been breached with conviction, as indicated by the strong upward candlestick as you see on the chart. So this breach is further confirmed by, let me just zoom in a bit to make it more clear for everyone. Okay, this breach is further confirmed by the 34 WMA crossing above both the 100 and 200 WMAs, suggesting a strong bullish sentiment. Now, the price has surged to a significant top at 2088.43, which we are identifying as a primary resistance level. If you see, and the RSI complements this view, remaining above 70, as you see here, and reinforcing the strength of the uptrend. However, as we've discussed, An RSI above 70 can also indicate overbought conditions, hinting at potential price pullback or consolidation. When comparing this chart to the previous one without the support and resistance levels, the addition of these levels provides us with potential targets and turning points. For instance, if a correction were to occur, the first support level at 2078.95, which aligns closely yes, which aligns closely with the recent breakout point, uh, could act as the initial floor for price retracements. Further down, the significant resistance zone, let me just zoom in here a bit. Yes, the significant resistance zone at 2065.25, which may now serve as a support level, presents a secondary target for the pullback. Considering the WMAs, if the pullback occurs, the 34 WMA could serve as a dynamic support level, potentially halting the correction. In the event of a stronger retracement, the 100 and 200 WMAs would be the next areas to watch for potential support. The probable scenario from this setup are as follows. First, we have I would like to conclude it in three different scenarios. First, the bullish continuation. If the price sustains above R1 and the RSI remains high without showing divergence, the market may continue its bullish trend, possibly reaching for new highs above the 2088.43 level. This is the first one, okay? The second scenario is that we can describe it as a mild correction. Let's say if the price retreats, finding support at the first support level, 2078.95, or the 34 WMA, maybe, falling further to 2065.25, or further at the 34 WMA, and the RSI corrects from its overbought state without dipping below 50, this would indicate a healthy correction within a strong bull market. And then when price is getting more closer to 34 WMA, then that would be a good point to look for a new entry, a buy entry to the market. And let's discuss the third scenario, deeper retracement, let's say. I think a break below ST, this resistance zone, and approaching S2 with the RSI falling for 50 or lower could signal a deeper correction, with the 100 and 200 WMAs acting as further support levels. So these are three different scenarios that we can generate from this market condition right now. Each scenario requires careful risk management as well. So traders should watch for how the price reacts at these support and resistance levels and adjust their positions accordingly. The stops should be placed with consideration of these levels to protect against unexpected breakouts or breakdowns. So in conclusion, the addition of support and resistance levels to our chart has provided valuable context to the price action and the RSI reading. So these levels give us a clear framework for predicting potential price movements and preparing trading strategies to capitalize on a protect protect against these movements. But let's get through the last slide that we have here. Let's turn our attention to a practical approach to managing risk when trading the gold chart. For example, as you see, as we have examined, Risk management is not just a safety net, it's the foundation upon which successful trading is built. So imagine you are in the uh, cockpit, let's say, of an airplane. Your stop loss orders are your altitude warning system. So set your stop loss just below significant WMA or recent swing low to alert you before hitting turbulence. If the 34 WMA has been a reliable support, placing a stop loss just beneath it can keep you in flight despite minor dips. As you gain altitude profits in our analogy, adjust your stop loss to a break-even point to secure your position. What does it mean? Now, consider the size of your trade, like the fuel in your tanks, okay? So you will need to calculate this based on the distance to your stop loss, ensuring you have enough to reach your destination, but not so much that a sudden storm could cause significant trouble. It means you always need to be really careful and aware of your free margin when you trade these types of market corrections. Then the leverage. Leverage is a powerful engine used wisely. It can propel you forward, but successive use during unpredictable corrections can lead to a nosedive. One of the setbacks to martingale risk management approach that many traders have is using the same leverage level when they want to double their bet against the market and wait until the price gets back in their favor. So it's really important a conservative use of leverage aligned with your risk tolerance keeps the engines running smoothly without the risk of a stall. And I would say let's move on and keep an eye on the horizon for economic releases and news. Unexpected events can cause turbulence. Staying informed helps you adjust your altitude and course uh, accordingly. Then monitor your instruments closely. Here, the RSI and price action are your gauges. Signs of the RSI returning to normal levels from an overbought condition may indicate smoother skies at while bullish price action patterns can signal a good altitude for reentry. And the last but not least, trailing stops. Those are like autopilot adjustments. They secure your profits as you climb. But please keep in mind that using trailing stop in very short time frames, according to the market fluctuations in shorter time frames, may not serve you as the best tool. So you you should make sure that the trade that your trade is going to continue in favor of the market direction. In that case, you can, of course, incorporate trailing stops as your autopilot adjustment because trailing stops secure your profits as you climb, allowing you to enjoy the ride with less hands-on control, yet keeping you safe if conditions change suddenly. The next one is diversification, uh, which is your somehow flight plan to multiple destinations. It ensures that if one route encounters bad weather, your journey can continue on other paths. Lastly, continuous reassessment of the market conditions is akin to a pilot's going checks. The market, like the weather, is ever changing, and a good pilot, much like a skilled trader, adjusts the flight plan as needed. So, by Embodying the rule of a careful and informed pilot, employing these risk management strategies, you will navigate the gold market's corrections with confidence, protecting your capital and setting a course for profitable destinations. Remember, effective risk management is what keeps you flying safe and reaching your trading goals. Very well. As we draw this session to a close, I want to thank each one of you for your active participation and insightful questions. For any question that remain unanswered, or if you seek further clarification, please don't hesitate to reach out. Thank you for joining me in this session, and I look forward to seeing you all excel in your trading endeavors, and I hope to see you also next week in our last session of price action trading, when we will conclude this course with the more practical strategies using the other technical tools and indicators. Thank you so much, and until next time, farewell and happy trading.